Hello, everyone, and welcome to this midweek solo episode. So, the NGX is having another solid week. The market continues to show strength. But here is an uncomfortable truth. Even in rising markets, many smart Nigerians are still losing money. Well, not because they lack intelligence, but because psychology works against them. Fear, greed, overconfidence, panic selling, and chasing hot stocks at the wrong time. So today I decided to talk about the psychology of investing in Nigeria and why smart people lose money. So we will look at the common mental traps Nigerian investors fall into, real examples from the market, who actually benefits when emotional investors make mistakes. And most importantly, we'll talk about how you can protect yourself. So, if you've ever sold a stock in panic, you held a losing position for far too long, or you've refused to take profit, or you bought a hot stock just because everyone else was talking about it. This episode right here is for you. So let's get into it. Okay, so welcome everyone to The Edge. If you are new to this channel, please subscribe to the channel and hit the notification bell. Here on The Edge, we cover the markets and concentrate your thoughts on how to make the best investing decision. So please like this video and share with your communities. So one of the biggest problems that most Nigerian investors face is the tendency, okay, to sell in panic moments. Whenever there's any issue, some profit taken, that tendency, the urge to want to quickly exit the position, it's a major problem that most investors see. So you buy a fundamentally strong company. So you've seen it, you've done your analysis, you buy a fundamentally strong company. A small correction happens, maybe due to profit taking or macro news, or suddenly you sell at a loss. You sell at a loss because the market is crashing. Every other person is selling. So you also join them and you sell. At the same time, many people don't have, profit taking targets. So when you buy a position, you expect the stocks to double or triple. You hold everything hoping that the stock will rise to the moon, and only to watch it to give back most of the gains in the next correction. So this combination, panic selling on the downside and no discipline in the upside, destroys compounding. It destroys your ability to be able to compound your wealth. In Nigeria, this is even made worse by volatility. We have a lot of volatility, whether it's from Naira movements, inflation, policy, uncertainty. So this creates its own form of volatility and tension, all right, in the market. So the emotional pain of seeing your account drop, maybe even 10, 15, or 20%. I know, I've been there, could sometimes feel unbearable. So people exit at worst possible time. Sometimes in the year, I did make a video on the do's and don'ts in a pre-election year. If you've not seen that video, please go on the channel and you watch the video. So the key takeaway here for me, before I go on to discuss some of the factors, is decide your exit rules before you buy. That's key. Before you go into a position, decide your exit rules. Have a profit taking plan. Am I going to sell when I make a profit of 30%? Am I going to sell when I make a profit of 50%? And have a maximum loss you are willing to take. Now, discipline beats intelligence in the market. So it's not so much about, being smart. Discipline will always beat intelligence anytime in the market. So closely related is the extreme dislike, okay? And I noticed this a lot. Extreme dislike for realizing losses on bad positions. You're already in a bad position. So what you need to do is to cut your losses and move on. So you buy a stock, maybe at 250 naira per stock, and then it falls to maybe 200. So instead of admitting that the thesis was wrong and you quickly reallocate your capital to a better opportunity, you continue to hold the stock until, with their expectation that it's going to come back, because selling would mean accepting you were wrong. This is classic loss aversion. So, and I see this a lot in the market. People holding losing positions for years, hoping for a miracle recovery. Now, while missing out on new opportunities in the current rally. So the sunk cost fallacy makes it worse, right? It makes it worse. And I've already lost so much. I can't sell now. So the real talk is every professional. I've not met an investor. I've not met an investor that have not made losses. So every professional has losses. The difference is they cut them quickly and move on. All right? Especially when you are, or when it has become clear that you have taken a bad position. I'm not talking about you taking a position in a company that is fundamentally strong, all right, but is facing the vicissitude or the vagaries of the market. No, I'm talking about when you know that this is completely a bad position, all right? So in the market, your capital is your best tool. So you don't have to tie it in dead positions. When you know that this is a bad position, what you do is to take your losses immediately and move on. So after a strong week like the one we have now, beginning to see many investors suddenly feel invincible. Okay, they suddenly feel invincible. You have that recency bias, that overconfidence coming in. So that recency bias makes you believe the market will keep going up because it went up recently. And so what do people do? You start increasing the position size, right? It's gone up. So you ignore valuation and convince yourself you've cracked the market. Then a correction of bad macro data hits, and over that overconfidence then turns into panic losses. So, I mean, this is even amplified with the age of, social media, where everyone is posting and buying the stock, or, these are the best stocks to buy, and you're not doing your due diligence. That's why here on the edge, I tell you that what we do is to frame the position, frame the idea, help you concentrate your thoughts on how to make the best investing decision. So if you're new to this channel, please subscribe to the channel, hit the notification bell so that you always be notified, and share with your communities. Okay. So when prices go up, every piece of good news, looks positive. But when a fundamentally strong company, dips on maybe temporary bad news, like, what we witnessed in the month of June, many people only see the negative and miss the buying opportunity. If you've been following this channel, I've been consistent in saying the stock market is probably the only market where the items are going on sale, but no one is buying. But if you walk into your popular, maybe you want to go buy clothing or something, and they say this cloth is selling at a discount, you quickly jump at it. But when you are told a stock is selling at a discount, nobody wants to touch it. All right. So valuation discipline is rare. That's the way I see it. For many people who maybe try to claim being smart in the market. So valuation discipline is rare. A strong company trading at a cheaper multiple is often ignored because, the price is falling, then the selective perception keeps investors from buying quality names when they become attractive. You've all seen what has happened from the beginning of July till now, okay? So last week, markets gained about 4%. On one day alone, it gained about 3.45 trillion naira, all right? But here on the edge, we kept talking about June being a time or presenting an opportunity for you to restock. All right. So that's how people who are smart or who are disciplined, who understand the market, play the market. Okay. So we've talked about why smart people lose money. So who makes the money when smart people lose money? Who makes the money when smart people lose? So now, here's the uncomfortable part that I like to discuss. When smart people lose in the market, so who makes that money? So in most cases, it is not necessarily people who are more intelligent. So, I've been talking about smart people. So it's not like there are some additional tier, people who are more intelligent that make the money. No. It is people who are more disciplined, more patient, more systematic. The market often transfers money from the emotional investor to the disciplined investor. I'm sure you must have heard that from Warren Buffett. That's what the market does. So there are about four groups of people, okay, that benefit. So I'm going to describe those four people. So the first group that benefits is the investor, okay, with a plan. An investor, this investor has a plan, has everything mapped out. So while the markets panic or why investors are selling because prices are falling, the prepared investor already has a watch list. They have a watch list, they have target prices, and they have cash waiting. So when the quality stocks correct, they are not guessing, they're already prepared. They are not guessing at all. They're already prepared. They are buying businesses. They already understand at better prices. So that is why your investment plan, your investment journey, you have to be committed to it. You have to do your analysis. You have to understand the stock. You have to understand the company. You have to understand the business. So what you do is to always watch out for when the stocks, when the valuations become cheaper. And the valuations cannot become cheaper when people don't sell. All right? That's how people who make money in the market, that's how they make money. All right. The second group is the patient investor. All right. I've talked about the investors with plans. So the second group is the patient investor. So many people enter into the stock market during rally because everyone is talking about it. But the patient investor already has a plan. So the patient investor maybe will be accumulating stocks as everyone is exiting. So when the sentiment is quiet and valuations are more attractive, the patient investor will keep accumulating. By the time the crowd then arrives, because there's one positive news, by the time the crowd arrives, the investor is already sitting on gains and can then decide whether to hold, to trim, or to rotate into a different position. That's another set of investors that benefit when smart people lose money. The third group is the professional or institutional investors. The likes of pension funds, asset managers, high net worth individuals, and foreign portfolio investors. Because why? They do better research. They do better research. They have better access to information, and they have a clearer process for managing risk. So they are not perfect. Okay, nobody is perfect. They're not perfect, but they are actually less likely to make decisions based on only, you know, a short market noise or 1 week market excitement. That one stock is going up and then they want to rush to buy, or that, one stock is coming down, they want to rush to buy. No, they take calculated decisions. So they are not going to jump at any opportunity. So the fourth group um, of first set of investors that benefit will be investors who understand liquidity. They understand liquidity. So liquidity matters a lot. Some stocks can move sharply, okay, because there are few sellers and limited free floats, or maybe some sudden demand. Retail investors often choose these moves. Maybe they choose these moves late because by the time you are entering, um, investors who are already prepared, who understand liquidity, are already positioned. So the more experienced investors have already entered before the move, and that excitement, with the excitement that comes because other people are joining, they exit quietly. And that's how they, make their money from the market. So the answer is simple. The people who make money are not always the smartest people in the room. And you can confirm that yourself. So you can probably look around you, people who make money. They are not the smartest people. They're not the smartest people. They are often the most prepared, the most patient, and the most disciplined. Those are the people that make money in the market. And I think even this cuts across, different types of investment. And even in real life, these are the people that forge ahead when others are laying back. So they buy, the set of people, they buy when others are afraid. That's it. They buy when others are afraid. And they do not just buy blindly because someone says this stock is going up, or because I just bought the stock, then, or you have a friend that just purchased a stock and then you then suddenly you became an investor in that company without doing your independent research, without understanding what the business does, who owns the business, what is the cash flow of the business like, what is the history of the business. Okay, would you be able to hold the stock if anything were to happen to the stock today or to the company? Would you be able to hold it for a year or more? Okay, so these are some of the decisions you need to make and settle within your mind before you decide to make that investment. So they sell people who are who follow the market, who are well prepared. They could decide to sell or trim when others are greedy, right? I do say this in the market: you cannot take all the profit. You cannot take all the profit. You take yours and leave the rest for others. That's it. So when others are greedy, these investors are rotating out, they trim their position and they sell. Because why? They entered earlier before every other person is joined the market. So they have that latitude, they can sell and they exit. So they understand that in the markets, psychology would always create opportunity for someone else. So that's the market. So psychology creates that opportunity because some investors are emotional. That's what we'll talk about this in behavioral finance. Some investors are emotional. Their emotions dictate what they buy and how they sell. So this will always create opportunity for investors in the markets. All right. So this is how you'd approach the market. This is how to approach the market whenever you are looking, especially looking to make long-term investments. You don't just jump in because every other person is buying. So this is why investing is not just about finding good stocks, right? It's not just about finding good stocks. It is about having the temperament, okay, to hold good stocks, the humility to cut bad losses, and the discipline not to chase every hot idea. So it's not every hot stock that you see that you want to buy. So that's the idea about investing. So I mentioned it's not just about finding good stock, but you have that temperament, you have that capacity to hold. Do you have the humility to be able to cut losses? Because it takes humility to agree that you've made a bad choice or that you are sitting on a bad position. So you must know that. Okay. So how do you protect yourself? Practice rules for investing. That's what I'm just going to tell you. So I'm going to give you a few ideas before making any purchase. So pre-commit to rules that would guide you. Pre-commit to rules on entry. Pre-commit to rules or have a rule on what your profit target or the maximum loss that you will take. Next, you have to review, your portfolio. Have a clear mind on what it is that you want to achieve. Not during market panics. Could be quarterly, all right? It could be quarterly. That gives you an opportunity to see through different cycles and have a clear head, have a clear mind on what you're looking at. And then you keep maybe a simple journal, why you bought the stock, okay? And why would you sell the stock? You have that written down. Let me know. Have you done that before? That you have a simple journal and say, I'm buying the stock because of XYZ. Okay, if you can have something that detailed, then you probably should not be investing. Probably you don't understand what you are buying. So you should be able to have an understanding of why you are making that decision. Okay. And if you want to sell, why are you selling this stock now? Okay. All right. So, and avoid listening to noises. So I know it's difficult to avoid that now with a lot of um, social media exposure. Okay. Social media exposure can amplify volatility or when there's this panic within the market. Social media can amplify. So you want to limit the amount of this noise that you consume. Okay. Then you focus on process over outcomes. That's key. Focus on process over outcomes because the process is equally as important as the outcome. It's equally as important as the results. So you focus on the process, judge yourself on whether you followed your rules, not on a daily price movement. Just so that's how to judge yourself. So psychology is the real battlefield for every investor and even for Nigerian investors or the Nigerian market as a whole. So you have to master your mind, and the numbers will do what? Will take care of themselves. Master your mind, and the numbers will take care of themselves. So the market will reward discipline more than intelligence. So the market is going to reward a disciplined investor, an investor that is prepared over, intelligence, over whether you're smart. So smart people lose money when they react emotionally. You chase late, you refuse to take losses, or you confuse a rising market with your skill because you purchased Dangote and then the next week it's gone up by 5%. You purchase GT, but then you've gone up, and then you kind of believe that you have that skill to be able to read the market. No. So the people who make money are usually those who prepare before the crowd arrives. So I've talked about that. They're able to manage the risk before things go wrong because when you purchase the stock at a cheaper level, your risk is lower compared to someone who is purchasing the stock when the prices have gone up. Okay, so the idea is to stay disciplined when everyone else is reacting or when everyone else is overreacting. Okay, that's it all for me today. If you've enjoyed this episode, please share with someone who invests in the NGS. Drop your comments, and I like to read your comments. Which psychological trap have you struggled with the most? I read all comments. I'll be back on the weekend to continue to talk more about the market. All right. Take care, everyone, and I see you. Bye.